Well, welcome everyone. And Tom, thank you so much for putting this together. Michelle Kosas here with ITR Economics to give you an update on how the economy is doing. Um, Overall, I know, hope everyone got some time to relax with their families over summer. I know we're heading into really planning season here. So no, probably the big questions are what's 26 going to look like? What do I need to be planning for? So definitely going to focus on 26 and our, that future outlook that we have. Also want to touch on, of course, kind of the tariff and trade situation. How's the economy holding up in that? We'll also touch on consumers, kind of B2B and industrial activity, certainly interest rates and a bit of pricing and take a look at those standard markets that we talk about every single quarter. So I'll give an overview of the economy here, but if you have questions, feel free to throw them in the chat. If I don't see them right away, Tom, you can either interrupt me midway and I can answer a question live, or we can just do some questions at the end as well. So, overall, I know definitely, Tom was mentioning a lot of you have been feeling quite a bit of uncertainty that absolutely matches what we've been hearing out there in the market, what the data shows too. And last time we talked, I showed you the following chart, which was economic policy uncertainty absolutely was skyrocketing. I have an update on this chart, and it's a more positive one. We're moving in the right direction here. So that uncertainty is beginning to come down. We appear to be past that peak. So as we're getting some more clarity on policies, as some deals with Europe or different areas, as those are getting sorted out and communicated, that uncertainty is starting to ease. And that's really a good thing because that prolonged period of uncertainty was a challenge for markets, especially in the B2B space or CapEx. Some people just were sort of staying on the sidelines for a little bit longer because of those heightened recession fears, or not really sure where trade policy will end up. So what are the costs going to be? So the good thing is that, as we're getting some more clarity, then I think that once people know what to plan for, then that, it makes the math a lot easier than when you have some kind of big unknowns in the equation. So really glad to see uncertainty coming down here. And this aligns with, next year we overall for 26 are expecting some positive growth, but a little bit more on the mellow side. Some of our headwinds are going to stick around for a little while, but at least on the tariff and trade policy side, things are beginning to improve. And then, as far as how is our trade doing through all of this? I can see that for our imports, Europe here in blue absolutely spiked there. I think that's probably going to come back down to earth a little. I think we did see some, people trying to front run or get ahead of some tariffs. So seeing a little bit of lumpiness in the data. Definitely happened in GDP too, where some people pulled in some imports just to get ahead of things and then kind of pulled back the next quarter. But overall, those are going to normalize over time. And then also Mexico, I want to point out here, looks like our trade with Mexico really on a pretty steady upward trajectory. So we have a pretty, tight trade relationship with Mexico there. Canada on the other side, our relationships maybe a little challenged right now, a little bit lower on the imports from Canada. And then the notable really big one that's different here over time has been China really is becoming less important. They're still one of our major trade partners that we're importing from, but they have kind of come down and are no longer, one of our most important trade partners. Now they're more kind of third in line for trade partners here. So overall, trade is holding up pretty well. Our exports have been accelerating, so good sign there. And how this is, kind of what this looks like for overall GDP did cause, as I said, some lumpiness in the data from the first quarter to the second quarter. But overall, GDP, so broad metric of the economy, is rising. So still on a growth trajectory here. You can see our forecast, little dots out here. That's overall a very positive trajectory through at least 2027. Maybe a little bit of a flatter period in late 26, early 27. That's really splitting hairs. I think overall the picture here is that the economy is growing and going to be in a better spot in the future. But one of the themes today, I think, is under the surface going to be these aggregate numbers do look good, and that should encourage you. But there is a lot of nuance to this particular cycle where some individual consumers or individual markets are experiencing the economy differently. So some of the growth is, really concentrated in certain sectors more than others. So, where we stand for the macroeconomy looking forward here, the leading indicators are generally positive, but there's a little variety in there. Some of them are a little more sluggish. They're not in a sharp rising trend, like a sharp V. It's more of a mellow trend. So that does play into our outlook for growth ahead is going to be a little more mild or moderate, certainly compared to that last cycle where we had like blockbuster growth in the early kind of coming out of the pandemic. We had a confluence of factors there that all added up to really high growth rates. Those are unlikely to repeat. We're heading towards milder growth rates, but still growth ahead. And we're beginning to see that uncertainty starting to ease. And as long as that continues in that positive direction of, more certainty, less uncertainty, I think some people are going to come off the sidelines and CapEx is going to gain a bit more steam. It's already accelerating, but that would really help us see some more material growth there. So when we look over at the metal trading markets, we'll have a whole segment later on where we go over each individual market. But what I want you to be preparing for in 26 is growth. Again, on the more on the muted, mild side relative to some prior cycles. Keep in mind that higher prices could be part of this. So really want to be thinking about how can you protect your margins in this cycle. And, there were, as far as some of the different markets here, some of the large equipment markets are still struggling from those interest rate headwinds. We did have to downgrade our heavy truck outlook, so we'll talk about that. And a little bit of a downgrade to our aerospace, but that's more of a supply side issue rather than a demand side issue for the aircraft space. And then some areas where things are quite positive right now are high tech, and also defense is doing quite well and poised to potentially benefit from that one big beautiful bill. And then high tech, that like data center demand, we're still seeing a lot of strength in that area as well. So giving you a look at what your forecast looks like here. So this is unchanged from the last quarter. So you can see the growth rates down here for the coming years. So we have, 1.8% growth projected for this year. But looking ahead, I know we're all going to be planning soon for 26. That's a 4.2% growth rate is what we expect for the MTI average monthly sales over that time. So certainly picking up, more positive. But if we look at the growth rate chart up here, this is a more mellow cycle. We're not up in the double digits this cycle. And then, pricing is also, as I said, going to be a factor here. So there is some risk that volume growth might not be as high, that prices could push this a bit higher. So you want to make sure that your margins are in a good spot. So what are you doing to improve your efficiency, manage your costs very effectively, your input costs? Otherwise, there is some margin risk this cycle. So give you a look at how your forecast is here. So generally growth ahead, but on the more muted side. Once we get out to 27, it'll be a little bit flatter. We have a little bit of a sluggish year there for the macroeconomy, and then it'll pick up again in 28. So overall, though, a pretty positive outlook for the coming years here. So I want to substantiate this as, why do we see growth in the coming years? Where is that coming from? And then also talk about more of those nuances under the surface. So I know some of you might not work as directly in the consumer markets, but the consumer is super important for the economy. When we look at GDP, about 60% of GDP is made up of consumer spending. So they are really the driver, the powerhouse of the economy. When the consumer is in a good spot and they're buying, then the downstream, those businesses are doing good, and B2B activity will be in a good spot. So what I want you to walk away with from my upcoming segment here on consumers is that they're in aggregate in a good position. However, there are some demographics that are strained. So I'm going to touch on some of those kind of weaker points or soft points, some of those points of discomfort. But I don't want you to focus as much on that downside, the ones that are feeling strained. They are out there, and I do want to acknowledge that element. But overall, I don't want you to lose the message of overall consumers are still doing quite well here. So really, one of the main bases for this is employment is relatively, it's at record highs. The growth rate slowed down. So you'll hear some headlines over some weak job numbers. What they're focusing in on more is just that the growth rate isn't as high as we would like, but it is record high levels of employment overall. And that is allowing people to make more money. Also, some demographic trends giving some employees some negotiating power with wages. So overall incomes are moving higher here. This data that I'm showing you also includes some government benefits in the income. That's where we see this spike back here from those prior stimulus payments. So we're technically not at record highs here, but that's just because there's that abnormal spike. But if we were to, kind of normalize and take that out, we're essentially, rising at record highs for income here. So this is going to allow people to spend more on goods and services, benefiting downstream businesses.
That 2020 line always gets messed up in any graph by 2020.
Oh yeah, there's forever, it's going to take a while before those move off the charts. Just like the Great Recession too was one that's
Right.
always a big, oh, I know exactly what that was. Absolutely. So another, angle on why consumers are doing pretty well here is, this is going to depend on their individual financial situation, but the home prices are for existing homes around record highs. So if you own your own home, probably sitting on some nice equity there, probably feeling fairly good about the home value. I know this is going to vary a little by market. There are some markets where the existing home prices came back down a little, but for the nation as a whole, they're at record highs. So that's going to be the blue line here. For the median existing home sale price. And then, for people that have their retirement accounts or brokerage accounts that have some stock portfolios out there, the stock market obviously had, quite a wobble earlier this year, but it's back up around record levels. And that can give people a bit more confidence to spend. So when you look at your 401k or your home value, that can add some levels of security when you feel like, okay, they're in a good spot. I'm making more money, generally employed, and my home's worth more, my stock portfolio is worth more, that nest egg is looking fairly good. So these are some positive signs here. And then one other point though here is that, for some people that maybe they're not doing that top line trend, maybe they're a little bit softer. There is also the possibility of borrowing as one method. So when we ran the analysis, it looks like consumers have more room to take on a bit more debt, and banks are out there lending. So bank credit is at record highs. So if you do want to finance something, they are willing and out there. And also the risk premium numbers for lending have come down a little, which tells me that the banks aren't all that worried about a recession risk right now. So in some of these, this is some of the positive evidence there. The result of that is we're beginning to see total retail sales accelerating. I know this maybe doesn't look as anywhere near as impressive as the prior cycle, but that one was quite the anomaly back there with that growth rate. But this growth rate is beginning to tick up. So retail sales are at a record high, and we're beginning to see some acceleration. Apologize if you can hear a train behind me. Don't know if that comes through or not. We have acceleration here in the retail space into mid to late next year. So generally more positive macroeconomy coming next year. So I want you to hold on to the overall, the aggregate picture is very important, and we are seeing growth there. The next segment I'm going to talk about is going to focus more on the nuance underneath those aggregate numbers where, we certainly know not everyone is feeling great in the economy right now. So one of the trends that we're seeing, this bifurcation, is that when we look at, the share of credit card, people with credit cards making just the minimum balance has been increasing. So that suggests some people are financially strained, that they're only able to make that minimum payment. But on the other side, the number of people, or the share of people making a full payment, is also increasing. So some people are just paying in full and they're able to do that. And then an increasing share is also not able to do that. So seeing two different pictures here as far as impact on the consumer. Some are definitely more strained here. So really it's going to come back to what are the unique demographic factors of, each individual, what's their unique situation. I talked about employment overall slowing growth, but at record highs. Wanted to look at a little bit of a sector breakdown here, just to show that not all sectors are doing the same. Um, I know that when you put a lot of lines on a chart, it's very hard to read, which color is which one. Um, so I'm going to cover this with a little table here. And these are ordered in the order of the growth rate, this 12-12 column here. So this top line with the highest growth right now is in education and health services, construction, leisure, and hospitality also rising at a higher rate. A little bit flat when we get down here to retail trade, just up 0.1% from a year ago. And then there's three different segments that are down year over year. So that means, some people out there have lost their jobs. Some of those have been in business and professional services, manufacturing, and transportation and warehousing. So this is showing this more just as an acknowledgement of under the surface, it's not one size fits all for the economy. In aggregate, we're doing pretty well, but we know that there are some softer spots where some people are struggling either from an employment perspective or from an more kind of an income perspective, that inflation in recent years had a different impact on, particularly on the lower income consumers that already, don't have a lot of discretionary income to begin with. However, the wealthier quartiles are doing really quite well and driving things upward on the aggregate. So this chart here, what I wanted to show you is we're looking at basically some essentials, so food, housing, and healthcare. And then what percent of the spending on those essentials is relative to someone's overall spending. And seeing 5 lines here because they're the 5 different quintiles of people's income. So the lowest 0 to 20% of people making the lowest income, 40 to, and so on. And then the top 20% on the other side. So we're seeing, kind of what is that burden for them of their overall spending? How much is going to essentials? You can see that the people making the least, that overall the overall trend here is people have been having to spend more on their on those essentials gradually over time. But this is, going back down to the mid 80s here. More recently, so this data just also ends in 2023, so it's not quite up to date. It's a little bit lag data. But you can see that with the recent spike in inflation, the people in these lower incomes, so in the case where the essentials take up a bigger chunk of their budget, that has increased in the recent years. But if we look at even from this kind of middle, the 40 to 60% of the income quartiles, and then the higher end of the income quartiles, the cost of essentials relative to their spending has actually gone down for the middle to upper income consumers. So the main takeaway I want you to have from this is just certainly the lower income, kind of the lower 40% of income, they're struggling a bit more with the cost of essentials as we went through the inflationary period, whereas middle class and the really high income are doing quite well. They're able to spend on more of those discretionary goods and a little bit less going to essentials right now. Really, though, the really high income, those are the kind of the biggest driver of retail growth. Really going back for a few decades here, on average, can be volatile. But this is just the highest quintile of people making the most income out there. What percentage of overall spending they make up. So they've been making up a bigger piece of the spending is being driven by the higher income consumers. So this really is more important for if you're consumer facing, understanding who is the end market you're serving. But I think there's a lot of nuance there, but also it's important to know just even if you're more B2B, what type of businesses are you selling into? Overall, the economy, consumers doing well, so businesses are going to do fairly well. Growth is on the horizon, but it's potentially going to be a little spotty. Not everyone is going to be feeling the same this cycle.
You know what? I got a comment on that,
Oh,
Michelle.
yeah.
I mean, and even it leads to a question. Even though our members are not consumer facing, this kind of data is still important because if you can get data down to the consumer level and predict what that's happening, because that all flows up to the first, second tiers of the supply chain, and our members are deep into the supply chain. So if you can recognize this early, but then before it hits your heat treat customer, you can actually do some shifts and make some different decisions early on as opposed to waiting for it. They're going, why are sales down? Well, 6 months ago, the consumer stopped buying X in our product line.
Yeah. Yeah, it really depends on, if they're targeting, kind of which of these demographics are your customers targeting. And if it's not even your direct customers, then, going a little further down the line, if you're able to estimate what your, kind of what your exposure is, certainly the higher people that have more exposure to the higher income consumers are doing better. Um, we'll also talk a little bit about those sectors too, like the high tech sectors. If you have a client that has some data center exposure, data centers are just going absolutely bonkers right now. So that's going to be very different from some of the more legacy manufacturing too.
Right. Thank
Yeah,
you.
but overall, I don't want you, I know it's like I'm showing you some of the cracks under the surface here, but I don't want you I don't want to take away of the consumers in a bad spot. It's more of overall they're doing well, but I definitely do want to acknowledge that it's not one size fits all. There are some segments where they're feeling more of that strain. And
Right.
also, it's not an immediate, some of these concerns, they could add up, but again, they're going to add up a little bit more. It takes a while for these pressures to build or become problematic. So this again goes to, you've heard us probably talk many times about the 2030s. Um, we're a little bit more concerned in the 2030s about how some of these gradual strains on the consumer might cumulatively add up more for the 2030s. So it doesn't mean a recession tomorrow by any means. It's more of we're in a good spot today, but we need to monitor how are these trends going because they could add up cumulatively and impact that 2030s outlook.
Right.
Yeah. Any other questions on the kind of how the consumers are doing here?
I mean, it's not a question this probably for this segment, but since you mentioned consumer spending, one of the things I'm interested to hear is, when you get talking about your 2030 nosedive potentially for the economy with just certain parameters going on, is that when you look at demographic shifts, the 35 to 55 market is growing and will continue to grow. That's where people make most of their money and spend most of their money. And I study a lot, I read a lot on this stuff. So the 35 to 55-year-old market, it's going to continue to grow to a record level to almost like the mid 2040s. So it's my hope and it's going to be interesting to see how that market where they make and spend most of their money drives the economy in the 30s, where we're predicting somewhat of a depression potentially. And
Yeah.
is it the lack of people in the front side of that and the back side that there's not enough people coming into the market that's potentially dying off? Because the baby boomers, that's when they're all going to potentially be, it's their time to go.
Yeah, that's where their healthcare, the very older generation, it'll be the peak of their healthcare needs. So they'll be generally probably more fixed income, not spending a lot on what they're spending on, most likely is going to be more healthcare heavy and
Right.
those related services for the, retirees at that point. And then,
Right.
there is going to be, the Gen Xers, the millennials will be out there certainly spending too. But we do have some smaller generations coming up behind, and that's part of it there. So it's more of like what that biggest generation, what they're going to be spending on, really that healthcare heavy towards the 2030s. Although
Well, and
also, yeah,
then there's always the $68 trillion transfer of wealth from the baby boomers to the next generations and how they're going to spend that money.
yeah, yeah, absolutely. Yeah, it'll be interesting to see how it's going to be interesting how to see how it plays out because someone was also questioning the some of the assumptions on also the life average lifespan too is if
Hmm.
they live a little bit longer or not as long, does that kind of shift the 2030s outlook a little, which certainly could. Part of our outlook is more, well, has a big government spending component there to it, so I think that'll be part
Right.
of it. But I would
Okay.
be more than happy if we could ever call off the 2030s as someone that would live through it. Hopefully that I would rather not go through it, but it does look like there's some, kind of some longer term problems gradually there. But yeah, demographics are part of it, certainly.
Well, that's why we have you to tell us when and what and where.
Yeah, as we get a little closer, we'll see that, like, I think that's where we've generally been calling for, definitely a tougher cycle in the 2030s, but our predictions will get more specific the closer we get to.
Right.
So
Right.
we'll update those and, if anything changes, shift accordingly there.
Awesome. Thank you.
Yeah. I guess just some other brief notes on the consumer. I think I have maybe two more slides on this. One of the tough spots too for affordability for, either the younger generation or maybe you have some kids that are in their 20s and 30s is the cost of buying a new home is, pretty steep. The affordability is tricky right now. So what you're looking at here is looking at home prices relative to wages, and can see that, at least for existing homes in blue here, we're looking at over almost 7 times the home cost will be almost 7 times what their wage is. And that this is pretty high historically. It's come down just a little bit, but it's, really high compared to some different periods in history here. So there's a couple different angles to the affordability. Obviously, interest rates too. Affordability has, or in this metric, has improved a little bit on new homes because some of those have come down in price. I think we might be, potentially building some slightly less fancy or slightly smaller houses could be part of that. But affordability is a pain point given only a small fraction of the economy is actually out there buying a house in any particular year. So this is, a pain point for those people that are, trying to get into the housing market and might feel like they're coming in a little bit late relative to what they expected. So home affordability is an issue, but it's not fully impacting everyone the same. You're in a different bucket if you've already owned your home well before the pandemic or were able to refinance at 3% rates. There's a huge chunk of people that have, locked in some really nice low mortgage rates or low interest rates on their mortgage and therefore mortgage payments. But, the ones still trying to get their foot in the door, that might be a bit painful for them in particular. So having a little bit of sluggishness in the new residential construction for single units too right now. They're down 2.2% year over year, so they're a little bit soft. We expect a little bit more decline into early 26 for the residential construction market, but then we do have some more positive times coming here in 2026. So we definitely do need to be building some more homes. I think affordability has been a constraint on both markets here. All right. So I want to switch over to more the industrial B2B space here, take a look at how those are doing, and also, and we'll do some pricing and interest rates, and then also over to your markets in particular. So someone asked me the other day, they'd heard some scarier sounding headlines. They asked me about bankruptcies, so I thought I would show you that. So both commercial and industrial loan delinquencies and bankruptcies here. So I know when you hear bankruptcies went up, that's not a good thing. But when you look at it relative to the past history here, you can see it just went, abnormally low for a while. It's really just currently starting to flatten out more in a very normal territory to where it had been in the late 2010s here. And same with delinquency too, a little bit of an upward movement here, but this is a 1.1% delinquency rate. It's not particularly high. So businesses are also in a good spot. Overall, corporate profits are at record highs. The growth rate has been a little bit slow relative to what we'd want to see, but record high corporate profits in a pretty good spot there. And not record high, but elevated cash levels for corporations as well. So overall, they're handling their debt well and they're making more money. So that's a good thing for, being out there and buying in the market. And in the industrial space here, we're beginning to see that acceleration that we've been calling for. So it is occurring here. I know 0.6% growth is on the mild side, but it is accelerating, moving upward as we expected here. So this is actually a forecast we had in place before all the tariffs, before all of that uncertainty, and it's actually still on track here. So we're quite pleased with that. That overall, this is part of our story, that there's the business cycle is kind of like a tide coming in and out, and certain current events can definitely cause some really choppy waters, some volatility, but that tide is still going in and out. So we can still predict, even through some of the noise and the volatility, there's still some patterns there that are still valid. And we're seeing that improvement here that was already foreshadowed by the leading indicators. But they are suggesting it's going to be the peak growth rate next year will be a little bit on the more mild side, mild to moderate for the industrial sector. So for the annual total level here, that does mean record high levels. So we think some of those investments in capacity in the last few years, when you onshore something, it takes potentially a few years to get things up and running. So following the pandemic, when we had that supply chain crunch and we had low interest rates, I think that got more people interested in, how can I secure my supply chain? And the low interest rates were there to finance it. So some of those projects that people invested in should be bringing some more capacity online that could help us reach some record levels for the industrial sector. And I want to give you another look here as far as something we sometimes use as a leading indicator here, because copper, it's used in so many different types of products that when we see a movement in copper prices, it can give us an inkling what momentum we might see in the economy. So we're comparing it here next to non-defense capital goods new orders growth rate, and I've shifted it forward by about 3/4 here, so that it suggests that this lighter blue line, the capital goods spending, that is going to continue to accelerate here. So again, this is a more gradual pace of rise here. It's not very steep, but that is further acceleration coming. And then I did want to mention, just in case anyone can get any bit of market share here, the data center is a booming market, and this is not good, not just for directly the data centers, but this suggests that we're going to need a lot more future power generation. So it's a good sign for electrical equipment and power generation. There'll be some kind of downstream benefits to some other industries. So this data center boom is, they're up 44%. They're slowing, but they're slowing from a really fast pace there. And we are forecasting further growth in this space. So that's going to suggest that there's more demand for power generation, could benefit some other equipment industries and construction down the line. And then I did want to mention real quickly, the non-residential sector, that's kind of an outlier relative to the macroeconomy because it doesn't move at the same time as the macroeconomy. It tends to have a lag. So because these projects tend to be large, there's a lot that goes into planning them, and then the actual build time can take a while. So when we look at put in place construction, it is actually in a phase D recession. So it's still feeling that initial jump in interest rates are showing up in that data now. So it's a little bit lagged compared to most of the rest of the macroeconomy already felt most of this blow already. But it takes a while to filter through to non-residential construction. So non-residential construction next year would be softer. But we do have some rise then coming in 27 for non-residential construction. You can see that in light blue here, the residential space leads non-residential by about 2 years. So I've shifted that forward. In general, it's a little bit volatile here, but it does suggest that the non-residential space will begin to recover and come out of that, be a gradual recovery at first, but then we'll expect some rise in 27. So if you have some exposure to this, just know that, in real time, the put in place, they won't be feeling as positive, the people in the non-residential space. Really big theme here for the coming years, has been, and it's going to continue to be, is really pricing pressures. So this is something I want you to be on the lookout for. And ultimately, inflation, we're expecting that to kind of come back and rear its head again. And there's a few reasons for that. I know tariffs probably popped to a lot of people's mind at first, but they're actually a few rungs down our list as far as potential causes go. Really, the primary reason we see some inflation coming has to do with the money supply, like monetary policy, and federal government spending that can have quite a bit of a lead time. So when we see the money supply increase or the government spending more, it can take 2 years before that filters down into changes in the consumer price index. So those suggest that the conditions are already there for inflation to pick up again. So right now, the consumer price index here, it's been slowing in growth, but we are projecting an inflection point right around now where we would see higher inflation next year, about 4%. So not as high as that last cycle, but still a bit higher than certainly the Federal Reserve is aiming for. So we expect more more pricing pressure coming in the coming year, partially based on this money supply trend here increasing, as well as this federal government spending here as well. So that prior spending in prior years pushing up, increasing demand for goods, and the money supply is kind of greasing the wheels of the economy there too. So more pressure also from a demand perspective. As the macro economy is picking up next year, there's more competition for those goods. More people are out there buying. It puts some pressure upward on prices. So over on the producer side, so the consumers still slowing in growth for their prices. The producer prices have already begun to pick up here, just up 1.4% overall. This is for final goods, but that is beginning to accelerate. I know there's a lot of variety under the surface here, though, as far as the input costs. So looking at some of the prices here, there's some places where people are saving, some where they're spending more. So I'd say oil, like oil and gas related things, those prices are a little soft right now. So people are saving there. The iron and steel being down a bit, that one is a little bit, I would say that's kind of masking the fact that, there's an additional tariff for some people depending on where they're sourcing from. So some people really uneven what type of prices they're experiencing really depends on where they're sourcing from in the current tariff environment. But the tariffs could add, add a little bit of upward pressure to that inflation outlook as well. We really expect some higher prices coming for electricity. That's something we want people to be on the lookout for, given those data centers being built and how power hungry they are. And then labor as well is going to be a pressure for prices. So from a margin perspective, I really want you to be prepared for the possibility that some of your input costs could start to jump. And you need to be careful about how your own pricing strategy, as well as managing those costs and any efficiency gains that you can make to protect your margins. So that, that kind of pressure here, we already saw it in the beginning of the year. So what I'm showing here is the difference between the growth rates for final goods and intermediate goods. So intermediate goods for a while were costing more relative to the final goods. So that was suggesting some people along the supply chain were getting a bit squeezed. So that's when it falls below the zero line here in that red. It's improved. That gap's kind of closed temporarily. So I'm happy to see that. But just know that there could be some of this pressure. So we're going to be monitoring, how are prices doing along the supply chain, and just want to make sure you're not getting squeezed. So electricity costs, want to take a quick look at a map here. Really varies quite a bit depending on where you are in the US. Obviously, the Midwest has, much better prices than, say, California, or I used to live in New Hampshire, so the Northeast up there is pretty high too for their electricity costs. So we're, starting from a different base rate depending on where your location is. In the next slide, I'm going to show you the growth rates as well. So we have some variability in how fast the prices have been rising, or a few pockets where they've actually gone down a little. But overall, most of this map, when I look at it, those, that's indicating that over the last year, the electricity prices were generally going up across the US. So want to have a strategy as far as securing the electricity needs that you have and managing those costs as well. Just a quick peek at labor here too. There's some variability in the cost of labor depending on what region you're in. But with inflation beginning to come back next year, we could see a little bit more pressure on cost of living increases. So a little bit more as far as demands for higher wages here. So what we're looking at here is that consumer price index. When it starts picking up again here, that suggests that wage growth as well, not a perfect fit, but they roughly do go together. We would expect to see some higher wage growth occurring in 26. There could be a little bit of a lag here, but we do expect, some higher wage pressures coming. But right now, with inflation having cooled a bit, people are holding on to their jobs a little bit more. This is the quit rate. So the quit rates have come down quite a bit. And that suggests that people are not quite as confident in the job market right now. So you could, if you wanted to hire to prepare for 26, if you needed some more hands on deck, you might be able to get a little bit more pick of the employment pool if you hired a bit sooner rather than waiting for when things when the macroeconomy is picking up. There'll be a little bit more competition for labor next year. Whereas if you hired a little sooner, you could have time to train them and a little bit more pick of the labor pool. So that's, depending on your individual projections as far as, if your market's growing about 4%, what does that mean for your labor needs? Do you already have everyone you need, or do you need a few extra people? All right, so when we have to talk about interest rates, I know they're not the most fun. Probably hear a lot of things about what's the Federal Reserve going to do in their September meeting in particular. People do expect them to lower the federal funds rate. So that's the dark blue line here. They, had previously taken it down a little bit, and then we're holding steady. The recent messaging does suggest that they're probably going to lower that federal funds rate again. But what I wanted to show you on this chart is that the longer term rates, so kind of multi-year loans, which most people out in the economy are not, they're not borrowing overnight, which is what the Federal Reserve, that one they're setting, is just an overnight rate. They're borrowing for a number of years, for 5, 10, 15, 30 years for a mortgage. So the longer term rates, there's more risk involved because there's a lot more time. So people out there in those lending markets, they're trying to factor in what are the inflation expectations for that next 5, 10 years? How is the economy going to do over the next few years? So we typically see those longer term rates, this light blue line. You can see that if the federal funds rate comes down, it can come down too, but it doesn't come down as much. It's not a 1-for-1. So there is some room where if the Federal Reserve does keep lowering rates, it could help pull down interest rates, but there's going to be some resistance to that for a few reasons. So we actually think that the longer term rates are more likely to stay in their current range in the near term, and they might actually move or are likely to move a bit higher later into the decade here. So we don't want people hanging on waiting for lower rates necessarily to fix things, or if you want to make an investment, probably not going to see a whole lot of improvement in interest rates. So I'd time those investments more on, when do you need to get this project up and online rather in what's the payback period of that project. I'd focus on those factors more than on trying to time the interest rates. So just wanted to give you kind of a rough long-term forecast for what we think the longer-term rates are going to trend as. So we see them in the coming years, it's going past 2030 here, generally moving higher. So we're moving more back into kind of a range of rates that got more used to back that was more than the 90s. So I think this was an inflection point, and we just don't think we're going to come down to these really ultra low rates for a number of reasons. Part of it has to do with the government needs to borrow quite a bit of money to fund their deficit. So unless they really turn that ship around, their borrowing needs are going to be higher in the coming years. So that's, part of the factor here. And as well as our interest rate expectations are a bit higher in the second half of the decade. So that's going to factor into the interest rate that people, are willing to accept when they're loaning out their money. They want to be made whole for the inflation out there. So from an interest rate perspective, this is really one of those headwinds for more the equipment and construction markets that we don't see it going away. But we do think people are going to begin to adjust to it. It's a little tougher when people are just waiting for, oh, this is temporary. If it just goes back down, then I'll buy. But the longer rates kind of stay higher, how long are you going to put off buying that home if you want a home for, for your new family? Or, kind of business is going to continue. So I think that people are going to acclimate. It's a little hard to pinpoint exactly when that is, or it might vary person to person. But we do think the economy will adjust. There were definitely decades where we had notably higher interest rates and people still were out there buying equipment, buying homes, things like that. So it's a damper in the near term. And it's something that we have to adjust to, but it's wouldn't say this is something that's terminal. It's not necessarily going to induce a recession, but it will keep a bit of a damper on growth in the equipment market. All right, so we're going to switch over now to your end markets. Um, take a quick spin around those. So wanted to start out on our first page here. We just have a snapshot, a dashboard of all of the indicators in the report here. So we have MTI's average sales on the top here and the growth rates for the next 3-year ends. I know 26 is coming up, so a big focus on that. Also see the current trends. The noticeable outliers here for me are that heavy truck and farm machinery are noticeably weaker than they're in a deeper downturn right now. And then next year, they're going to spring back up. They'll have a higher growth rate. Part of that's that they're comparing to a particularly weak 2025. So I'll give a little bit more of a boost to the what they're comparing to will impact that growth rate. But overall, most of the growth rates that we're seeing here are going to be in kind of the low single digits. We do have some more growth coming, but again, it's not going to be super high, fast-paced growth. So we already took a look at the MTI sales there. We've looked at the industrial production. Will be accelerating into mid to late next year. Same with capital goods new orders will accelerate next year, so planning for better times. Construction machinery is just sort of turn the corner into an early phase A recovery. We do have growth coming there later in the year. Part of this one is dollar denominated, so I think pricing has been a little bit of this, but seeing some improvement in the machinery new orders for next year. And then automotive, I know that's a big market for a lot of people. This one has been a bit sluggish. We did see, some impacts to consumer behavior with the tariffs. Some people that really needed a car went out there and bought one fast. So we saw a little bit of a jump in the sales. But then kind of those uncertainties, I think, have put a bit of a damper on the people that, maybe don't need a car as immediately. So the production is still in a declining trend here in phase D recession, but we are expecting 3% growth next year. So the auto market will be coming back next year. Again, interest rates also a little bit of a headwind here, but sometimes there can be some promotional financing, some other methods to encourage the vehicle production. This one too is very exposed to the complex supply chain that they have. They have a bit more exposure to trade policy too, and especially in auto. Heavy truck, this is one where we did have to downgrade the outlook here. I think the concern here is that, freight activity has picked up a bit, but I think that they're probably having a hard time, they want to make sure they're discerning, is this just a little jump in freight from tariffs, or is this going to be sustained? So I think that they need a little bit more certainty, because the trucking market went through definitely a downturn in some of the previous years with their revenue and their prices. So they recently, having been burned, I think they're a little bit sensitive to, is the rise going to be sustained or not? And there are still those higher interest rates. So I think they're a little hesitant to add to their fleets right now. But as the macroeconomy is, improving, we see higher retail sales already and already accelerating industrial activity. That's a good thing for the movement of goods. Also record high wholesale trade. So we think that's going to give them some confidence to buy some more trucks in the future, but they're just a little bit hesitant to kind of go out there and buy just yet. So some lingering headwinds are, especially prominent in this heavy truck market right now. Oil and gas, if you're more midstream, the extraction is at record high levels. Growth has slowed, but we expect general growth in the years ahead. The pain points in the oil and gas market are upstream. They're more the exploration and drilling parts. So if you're selling some of the mining equipment that goes into those early phases of exploration and drilling, probably felt a little bit more downward pressure here than is indicated on this chart. But the kind of midstream or also downstream in some of the chemical markets, those are also growing quite well right now. So it depends on where your exposure is within the supply chain for oil and gas. But overall, we have some record highs coming for extraction, a little bit soft, but beginning to recover on that drilling and exploration side. Medical equipment too here is, they've come down quite a bit. The domestic market can face a lot of competition from from imports. So it'll be interesting to see how that kind of normalizes here, but we do have the very slightest almost ticking up here, but it's not quite phase or made it into phase A recovery here. We do expect this to improve here. There is quite a large healthcare demand out there already. And the revenue is looking pretty good at hospitals or at medical labs. So that's a good sign for demand for these. Uh, for medical goods, it really just depends on how much can the domestic market capture that and hold it, as opposed to losing it to some competition from some of the imports. So it'll be interesting to see how the trade policy may or may not impact this market. But that's the story here more has to do with those competitive factors rather than on the demand side. Overall demand for these goods is should be quite elevated still. Obviously depends on which particular ones, but over in the aircraft industry. So civilian aircraft, we did take this down just a notch. They can have some, they're very prone to having strikes or different supply chain issues. We just took it down a notch because of the latest data was coming in a bit soft. But from a demand side perspective, when we look at the new orders coming into the aircraft space, they're in a pretty good spot. So we think those will support general rise ahead. Just a little bit of softness, kind of flat in the near term before rise takes hold. Really just depends on, how much they can get their supply chain issues straightened out and kind of sustain higher levels of production to meet the demand that's out there. And then computer and electronics, definitely a growing market here. Growth will slow down a little bit next year and then a little flatter in 27, but this is more the high tech side of things. Will have some growth in the coming years, especially with AI really taking a hold here as well. And one last market here, we have the farm machinery. This one is a little bit soft here as well. Had some softer crop prices for a while and those interest rates. So the farm income was negatively impacted, but we're starting to see some improvement, some phase A recovery there. So that should translate to some improvement for the farm machinery space in the coming quarters as well. I know I had a lot of talking here today. So I want to make sure I do give you some time for any questions. Has anyone sent any in already?
I don't see any.
Okay, so if anyone wants to brainstorm some questions, or Tom, if you happen to have any, if not, let people go a few minutes early. So my takeaways here for you is that 26 is looking like a better year from the leading indicators. The consumers are in a steady spot. Businesses financially are doing quite well. So there's certainly ability to spend out there. The banks are lending. So there's growth ahead, but there could be some pricing pressures that come with that. So we really have to pay attention to managing your margins and your costs. Just because they're multifactorial as far as those prices, the labor market being a bit tight still, kind of some of those electricity or power costs. The nationalism can lead to some higher prices. So some pricing pressures are definitely a theme. And interest rates, we're expecting those to remain kind of a headwind. We don't expect a huge drop like people would like to see, I think. So not a meaningful decline in interest rates there. Could see a little bit of relief in the near term, but overall there's some pressures that suggest generally higher interest rates. So when do want people to be investing in their business, but just keeping an eye on, what's the payback period on that so that you're entering the 2030s with limited amounts of debt and have your budget and, balance sheet in a really good spot going into the 2030s.
Michelle, I would say, after, I said at the beginning, I think before the recording started, before we started this, that we just surveyed our members about 2 weeks ago on is uncertainty in the marketplace a big deal for you right now? And 69, I think it's 69 to 70% said yes, it is. It's just that, and some people are uncertain about different things, but there's uncertainty in the marketplace, and we appreciate you and your team bringing more certainty to the marketplace so they can make really good decisions. Because when you're making when you're making buying decisions that have two commas in it, you want to make really sure that the economy is going to a place that it's a good spot, right?
Yeah,
So,
those are tough decisions to make, especially
yes,
with uncertainty.
yes, I wanted to just reinforce to the members of the note that I put out there that this replay of this and also the 24-page report that they do for MTI with all the different industries, as well as the slides that Michelle passed. That'll be posted tonight, and you'll get an email tomorrow from our online forum to be able to watch the video and download those two sets of documents. So appreciate y'all attendance. And Michelle, thank you for all the things that y'all do for us with ITR.
Oh, my pleasure. Yeah, I love working with you all and hope you have a good planning season here. Certainly, feel free to reach out if you have any questions, anything I can help with and clarify.
All right,
And thank
thank
you
you,
to everyone.
Michelle.
All right, thank you. Take
Thanks
care.
everybody for attending.